How much time should I try to leave at the end for just a full question session, do you think? All right. All right. I've been told I can talk, so I'm going to try to see if I can move quickly through some of these slides here. Nice to meet everyone here. My name is Eric Broad. I'm the CEO of Bowery Legal. I am an emerging companies tech and venture capital attorney, which means that I and the other attorneys, I think some of whom are in the crowd here at Bowery Legal, we work with private companies, mostly tech or tech-enabled startups, a lot of them either venture-backed or seeking to be venture-backed from the earliest stages, helping people to get set up, do everything related to the equity structure, protecting IP, making sure it's assigned to the company, fundraising, which we're going to be talking about today, which if there's any transaction that is kind of our bread and butter, that is equity financings, later on debt financings, stuff like that. We also do M&A commercial agreements. We're basically outside general counsel for companies, and they come to us and we help them with everything that they need on the legal side. And we also have a team of experts if things get complicated in areas like tax, employment, equity compensation, IP, et cetera. We also work with investors. We have a bunch of VCs that are clients of ours, also some PE funds and some family offices. But today we're going to talk about what everyone is hopefully starting to do more of these days, with a little bit of a pause over the last 8 to 10 months, which is equity financing. So Jason, should I just go ahead and launch into the slides here, or do you want to? All right. Great. So here's what we're talking about today: term sheets and equity financings, what to expect when you're expecting a financing round, which it sounds like a lot of you are, which is really exciting to get to that level. And there's obviously a lot to know. So, a lot of you might have heard this. There's a great resource for people who are kind of new to this, by the way. It's kind of like the 101 of like how to think about a term sheet and how to think about financing. There's a book written by Brad Feld, and I think it's either called like Term Sheets or Venture Financings, How to Be Smarter Than Your VC Attorney, something like that. It's written by Brad Feld, and it's really good, and it goes into all the elements of a term sheet. And Brad Feld, correctly identifies kind of the two main things that you're going to be working through when you're putting together a term sheet, and kind of, it's obvious, but it also is helpful to kind of think about how term sheets operate in these buckets. So the two things are economics. What are the commercial terms the parties are agreeing to? Everyone knows about valuation, right? The valuation is sometimes can be a little bit random. Obviously, it pairs with the stage of the company. A lot of times the valuation is dictated by how much you're trying to raise on the one hand and how much the investors are trying to buy of the company on the other hand, right? If you're trying to raise 2.5 million and the investors are trying to buy 20% of the company, then you're going to probably end up with a somewhere around a 10 million pre and a 2.5 million raise and a 12.5 million post. Doesn't always work out that way, but that's kind of how some of this venture math ends up working out. But the investors are also thinking in terms of economics about how do they protect their investment. There are going to be certain votes that they want to control, or approval rights they want to have over the company for how you might spend large chunks of your money, or how you might, what's an acceptable risk that the company might be able to take in terms of a debt burden onto the company based on the amount of cash that you're getting from the investors, above which the investors would need to have an approval right over that. And also the economics of the shares that they're getting, right? If they're getting preferred shares, what are the terms of that? They want to get their money out first in a downside exit event. That's called liquidation preference. So there's a bunch of things that factor into the economics of the company and the economics specifically of the investor, protecting their investment. And then control. Do the investors get a board seat? Is it around where the investors are potentially balancing the board? Meaning there's the same amount of investor directors as there are founder directors or management directors appointed by the common stock. What kind of negative covenants do they have over the company through protective provisions and covenants in the investors' rights agreement and in other agreements? Ways in which the investors might not be able to affirmatively control. I say in here, control often means that they can prevent the company from doing things. It usually does not mean that they can force the company to do things, which is really good. For a lot of you that are doing your first equity financing potentially, it should be the case across the board generally that investors will want a board seat, but it will be very, very atypical for the investors to get control of the board. So what that typically means is after your first equity financing, you'll have a board of 3 directors, most typically, unless you have 3 or more founders that all kind of want to have seats, in which case it might be more. But you usually have 3 directors. 2 will be appointed by the common stock, aka usually the founders, and 1 will be appointed by the investor. And that means that the founders will always be able to outvote the investor. But if the investor doesn't agree, you can't do things by unanimous written consent. You have to do it by vote at a board meeting. And so, these topics will kind of weave throughout what we're going to talk about here today. So one good resource, another good resource, aside from the Brad Feld book that really digs into classic term sheet terms and how to think about them, is the NVCA model term sheet. So there's an enhanced model term sheet. There's a couple different models on the website. The enhanced model term sheet is really good, actually, because if you go to the bottom of the term sheet, it has charts and statistics about what you can expect. I forget everything that it goes into, but I think it goes into like what typical valuations are for different rounds, seed, series A, B, C, what percentage of the company you should expect to be selling in each different round, the presence of certain terms in rounds, or what you should expect maybe not to see in certain term sheets. And so if you're really trying to get a sense for ammunition of how should I think about a term sheet, what is normal, how should I think strategically about approaching my fundraise and approaching investors, and sometimes investors ask for you to kind of put your cards on the table first. What are you looking for in terms of valuation and maybe terms? That can give you a little bit of an education on what you're looking for. When you're going through the model term sheet, it's an annotated document. So there's a bunch of footnotes that are really helpful. It's really dry. It's not the most exciting read unless you like that kind of stuff. But there are footnotes that kind of describe a lot of the different provisions and how to think about them, especially where there's something that might be notable. In the model term sheet, there are also some areas where there are alternatives present. And I wrote here, where there are alternative options present, assume the best and most standard option is the first option listed. So if you look at the sections on dividends, I think the first section basically says dividends will be paid to the preferred stock when, as, and if declared by the board. That basically just means that the company is not required to make dividends. There's no cumulative dividend, which is essentially like a coupon, or it's almost like interest that accrues over time. There's no expectations of dividends or priority dividend. It just means that if you pay dividends on the common stock or any other class of stock, the preferred gets to share too. And then there's 2 other options that are a little bit less standard. The third being cumulative dividends, and that is something that you don't want to see. It's a bad sign. There are some we'll talk about a couple of these instances, but there are some PE mixed with VC funds that operate in the VC world, and private equity has a little bit different goals in mind when they're investing in companies. And they look for things like a consistent return on things like cumulative dividends, or potentially redemption rights, which are even worse than cumulative dividends. We'll talk a little bit about that later as well. But if you were just kind of on your own and looking at the model term sheet, generally that first option on the dividend section, on the liquidation preference section, we'll talk about this later as well, but there's 1x liquidation preference, non-participating. That is the standard. Then you could potentially have 2 times liquidation preference, which means in a scenario where you sell the company and investors wouldn't get more than their money back by converting to common stock, then they get their money back first. If there's a 2x liquidation preference, that means they get 2 times what they paid in. They paid in $1 million. They either get 2 million back or whatever percentage of the proceeds there are, if it's less than that, or they get what they would get if they converted to common. That's liquidation preference, a classic investor protection. There's a couple other options there as well. Another, yeah, sure. Yeah, after you pay expenses and creditors and all of that stuff, that all comes out of the 5 million as well. So it does, and it is totally normal and expected to have 1x liquidation preference. It is really bad to have anything above or really different than that, for a couple of reasons. The one is just the math, the way that Jason just described it. If you've raised $10 million and you have 1x liquidation preference and you sell for 15, the 5 million after expenses is what you get. If you have 2x liquidation preference and you've raised 10, you don't get anything, right? The 15 goes all to the investors. The issue as well is once you get that into your company, then every investor after that is going to see that and they're going to want the same thing. And that is there's a precedential value in your first financing, even if the company is generally doing pretty well. And so there are certain things that you really want to fight back against. I haven't seen, we're in an investor market right now. I haven't seen investors kind of in early financings where a company is not struggling. It's kind of its initial round. I haven't seen them pushing for weird things in the liquidation preference area, but I have seen it for companies that have raised and are now getting to the end of their runway and are struggling to raise again. And investors see it as a riskier investment. You do kind of see that in down rounds. There are a couple things that you see in down rounds, and that's one of them. And in a down round, you fight if you can, but you can't always. At a certain point, 100% of nothing is nothing, and so you're going to try to raise and save the company and hope you can get these terms out in a later financing if you right the ship. Um, yeah, right. Yeah, yeah. Totally agree with all of that. The second point here for people who are looking through the model term sheet and thinking, how do I kind of suss out what's important here and how to think about these this template. Um, Again, this is just a rule of thumb. It doesn't apply to everywhere, but when an entire provision is bracketed and it's not something like you're filling in a share number or a dollar amount or something that's just clearly needs to be filled in to complete the sentence, and there are no other alternatives present, you might be able to assume it's not something you see all of the time, only some of the time. You know, I, I'm available to the extent anyone ever wants to talk about any of these things. Please feel free to reach out. I'm trying to give you tools right now for if you're looking at this, what could be a confusing document. how to think about what you're seeing here. So if you see in the protective provisions, there's a protective provision over equity compensation plans and board size. There's also provisions later on pay to play and redemption. For those of you who don't know, the protective provisions are stockholder votes that are in the certificate of incorporation. And typically in your first equity round, it says something like, the company can't take the following actions unless they get approval of a majority of the holders of the preferred stock. The classic formulation of protective provisions is majority of all preferred voting together as a class on an as converted basis. Sometimes you have series specific preferred votes, protective provisions, and that's if you've done a series seed and a series A and a series B, and there are reasons for each series to want their own votes. It is important to think about those protective provisions series specific votes, that they should really be as narrow as possible if you're on your second round. And I won't focus on this too much because I think a lot of you are on your first, but basically it should be, you can't amend the charter to do something that it would adversely affect the Series A stock or something like, or Series B. You can't create, authorize, or issue any more Series B. And the point there is, you can't screw the Series B investors by changing the charter in a way without their vote, and you can't just authorize a bunch of new Series B and issue that out and dilute the people who parties that would typically control the vote out of their control of that vote or their ability to block that vote, and in that way kind of do an end around. And those are if you have series votes, those are the classic ones, and you really don't want anything to get beyond that. We'll talk a little bit later about how philosophically, you want to think about investor votes being things that are protective, again, of their individual economics and of, significant decisions that could be existential potentially for the company. And you don't want investors to have a bunch of votes over things that are really operational in nature and day-to-day business decisions, or just really ordinary course business decisions. Because you don't need their oversight, and they shouldn't be demanding that in a lot of ways. We'll talk about that a little bit. But just to get back to this point, the protective provisions over equity compensation plans, can you increase the size of a plan that is meant to have shares that you're going to grant to service providers? That one you see sometimes, but you don't see it all the time. Same thing about increase or decrease the board size, although to the extent a director is getting an investor is getting a seat on the board, they might want that, and that's fine to give. Pay to play and redemption, those are bracketed because you don't typically see them. We'll talk about it a little bit more later. Pay to play is something that really only comes into play in a down round, and we could have a whole long discussion about like what that is and what the risks are, and how you put it into effect. So not going to linger. Yeah. No, I was still focusing on this one, but I'll get to the, yeah. So while we're on the topic of things that you don't want to see in a term sheet, take note of each of these points below. All of these, I would say, are generally red flags in an initial term sheet in a first financing of the company, right? A lot of these things are things that either it's an investor who is not a true blue VC, and they're maybe dabbling a little bit in VC style tech investing, but they have other investment characteristics that they might lean back on. We talked a little bit about dividends and redemption rights, or it just means that they're trying to get a deal that is really bad for the company, and it should be a red flag on whether you want to partner with them. Redemption rights is a huge one. Basically, redemption rights give the investors, if they're present, the right to a call right, essentially, the right to mandatorily redeem their shares back from the company at a certain period of point in time, maybe 5 years or 7 years after they make the investment. And oftentimes it comes with some sort of accruing interest or a coupon over time, like 5 or 7%. So they put in $1 million, and 6 years later, on the sixth anniversary of the financing, they can get all their money back plus 6% interest that accrued over that period of time. And hopefully, 6 years later, the company will have cash reserves that amount to greater than its first equity financing, but you never want to be put in a position where investors can pull the rug out from under the company, force you to give all their money back plus interest. That is not the way that that VC style investments should be seen, right? They should be, the VC comes in, they're partnering with the company. Either everyone wins in a upside scenario, or nobody wins in a downside scenario, or there's some sort of middle ground exit and they have their liquidation preference and they get their money back. But they shouldn't be able to rip their money back out of the company without the company essentially entering into some sort of transaction that allows for that. So redemption rights are a huge one. You never want to have them. And if you ever see them, say no, give us a call. We'll say no for you. Participating preferred or anything greater than a 1x liquidation preference. So one more thing on redemption rights, and it applies to every one of these provisions. And I said it before. The precedential value of what you have in your documents is really important in your first financing. So I use an example for redemption rights, right? You raise $1 million, and then 6 years later, you have to pay back $1 million plus 6% interest. Maybe that's not so bad, but then the next investors and the investors after that, and maybe the ones after that, they all might want redemption rights. And so it's not so simple as, well, now we have 30 million in reserve, so we can easily pay this 1 million. It's, you're putting yourself into a perpetual cycle of potentially needing to redeem out investors significant amounts of money in an unpredictable way that could potentially, kill the company. Not that people are necessarily going to want to do that, but that is another key here with all of these provisions. Participating preferred, that's when an investor gets paid back their liquidation preference in a sale of the company. So I put in $1 million. First thing that comes out of the company if you sell is $1 million back to me. And then I get to participate based on my pro rata share. So if I have 20% of the company at the time of a sale, I also get 20% of the proceeds that pay out after. That's what we call piggish, right? I mean, they should either get their money back, that's their protection, or they get to share if it's an upside sale. Anything other than that is just generally frowned upon in the industry. Same thing with 1x, anything greater than a 1x liquidation preference. Full ratchet anti-dilution. It's a little bit of a complicated topic, but basically, if you raise money at a certain valuation and then later on you raise at a lower valuation, that's a down round. Full ratchet anti-dilution means that the conversion price of shares of preferred ratchets down automatically to the price in which you sell in a down round. Or if you issue shares for free, it would ratchet all the way down to that price per share. And it's it would take too much time to go into exactly how it all worked. But suffice it to say that full ratchet anti-dilution gives investors a significant amount of leverage in down rounds to put in insidious terms into the documents. Or it threatens the founders to have a significant amount of dilution every time you have a down round. Essentially makes the previous investors whole anytime you do a down round. So if they, bought shares at $1 per share and you sell later on and it was a $10 million valuation, you sell later on at a $5 million valuation for 50 cents a share to future investors. That means your previous investors now have twice as much of the company as they did before because their price per share ratchets down to 50 cents. So they would have twice as many shares. It is something that you see sometimes in down rounds. You shouldn't see it in a first round. Cumulative dividends, it just means like accruing over time, 7% or 8% or whatever it is, year over year. And it's also generally frowned upon and not really what VC investors should be aimed at getting, these kind of like, standard kind of lower percentage returns year over year. Investors gaining board control. This will happen. This is something that is always negotiated. I get a lot of questions about with early stage companies about how can I set my company up with either super voting shares or set the board up and put something in agreement so that investors can never get control of the company no matter what happens. And the answer is you can't, because investor gaining control is something that is negotiated. And it only happens if you have to give investors control because you have to do so in order to raise money. But you shouldn't have to do that in your first equity financing. So the example before was investor director gets one seat, the founders of the common stock get 2 seats. In your second financing, the lead investor in your Series B financing gets another seat. The board is increased to 5. Now you have 2 investor directors, 3 common stock directors, again, typically appointed by the founders. So 3 outnumbers 2. In your next financing, if things are going well, another investor director might come in. The board goes up to 7, 4 appointed by the common, 3 appointed by the investors. If things aren't going so well, maybe you get to your third financing and the investors say, in order for us to put money into the company, we need a balanced board. 3 investor directors, 3 common directors, 1 independent director, mutually agreed between the 2 parties. That is the way that it's got to be. That is usually the natural step before in just a complete investor controlled board. But it's only something that will happen if you agree to give investors that control. And unfortunately, once that happens, it's really hard to gain common control back of the board. So it's a really important decision. You could try to argue that there's some sort of control premium should be priced into the round. Difficult argument to make because, investors are not maybe as bullish on the company as you'd want them to be anyway. Otherwise, they wouldn't be asking for control. But you never want to see this in the first financing. So that's why it's there. And then significant operational controls beyond what are in the model term sheet. And we will talk about some of those now. So I mentioned the protective provisions earlier. These are negative shareholder control, meaning they can't push the company to do anything. They can't make decisions over the company, but you have to go to them in order to have their approval for certain company actions. The classic ones are, a deemed liquidation event. So you basically can't sell or liquidate the company without their approval. You can't issue new shares of preferred. There are certain provisions in the protective provisions that would essentially give investors control over whether you're able to do a next round equity financing. It's really common for them to be able to piece together certain votes to block you from being able to do a financing. There are ways that you want to kind of carve up some of those provisions, but you should expect generally that investors would want that approval and that usually they're aligned with you and wanting you to raise money, grow, give them a return on their investment. So it's weird for them to kind of withhold that control unless in a later financing withhold that approval unless in a later financing you're going to do something that would negatively disproportionately affect them, in which case, they want to be able to have a little bit of leverage to negotiate that out. So the protective provisions are found in the certificate of incorporation. We can get into Delaware kind of legal underpinning philosophies, but protective provisions, because they are shareholder votes, do not come along with fiduciary duties. The investor director covenants, which are negative covenants that are found in the investors' rights agreement, do come with fiduciary duties because it's about it's a director vote, and directors have a fiduciary duty to act in the best interest of the company and its shareholders. And so there's a little bit of a balance there theoretically on how they should be thinking about the decisions they're making. The investor director covenants are something that on the company side, if you can keep them out, keep them out. Once these get into similar to the protective provisions, these are the type of list that can grow in each successive financing, right? It's just kind of sitting there and investors see it and they think to themselves, what else do I want approval over? What else do I normally like to ask for? Let's just tack on a few things here and see if I can get it to stick. That happens in the protective provisions section as well. But protective provisions are so standard that you can really never get them out of financings. I think the investor director covenants on the West Coast for a while were not really present in a lot of financings. In the East Coast, they were more present. Sometimes you can keep them out. Sometimes you can't. My advice, if you can't keep them out, which is common that they end up in there, is I like to try to tailor those so they are really only control over what you would consider affiliate transactions or interested party transactions. For example, increasing the compensation of the executives of the company, right? If it's a a common stock controlled board. It's controlled by the founders, and they want to give themselves a nice fat raise on the using the money that the investors just put into the company. It's reasonable the investors would want to have approval over that. If you're going to make a loan to one of the executives of the company or guarantee a loan made by them using the backing of the money of the investors, it's reasonable they would want to be able to approve that, or any other agreement with what would be considered a related party, which is usually included in there. So there are certain things where it's like, okay, there, it's reasonable that investors would want oversight over these kind of conflicted interest insider transactions. Everything else, entering into new lines of business in the company, we really don't care what investors have to say in a lot of instances about. We want their advice, but we don't necessarily want their approval. Certain strategic transactions. Yeah, 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 yeah. No, that's an important point too. I mean, so once you agree on terms in a term sheet, you need a really good reason to retrade those terms. Investors, we'll talk about it in one of the next slides, but investors use diligence to see what's going on with the company after they sign a term sheet. And sometimes they just say, listen, we saw something we weren't expecting. We need to change things. Really hard for a company to say, we didn't know what we were agreeing to. And now we need to go and we need to back these out. So the term sheet is really, really important. There are also really important provisions that get into the documents or get into drafts that are almost never going to be seen in a term sheet. There's one that is, whether you have to be providing services to the company to participate in certain common shareholder votes. You rarely see that in a term sheet. It almost always ends up in documents. Investors don't want founders that are no longer with the company to be able to control votes. Sometimes founders don't want that either, but it's really important that you understand where these provisions are popping up in the documents, and that you make an educated decision over, what you want that to be going forward. And obviously that's the type of stuff that we help with all the time, but it is really important. And once these things get into the documents in the first round, like I've been saying, it's really hard to get them out. And then you're living in a house that you've created, and you can move things around, but like the general structure tends to stay there for a lot of the life of the company, if not the entire life of the company. So just to tick through these other points here, the investor director covenants in the investors' rights agreement, like I was saying, try to tailor those to related party transactions. Investors get control over board seat and other kind of board investor director approvals that are sprinkled throughout all the documents. That's something that doesn't typically, the other investor director votes don't typically show up in the term sheet. They always show up in the financing documents. And then numerous other voting and consent rights, whether the company can deem liquidation, sell, or liquidate. A drag along, if there's a sale of the company, they get the right to vote on whether you can drag other people into it. Amendment and termination provisions of the investors' rights agreement, ROFR and voting agreement, waiver of anti-dilution or issuance of non-exempted securities. Those are shares you can issue that wouldn't be subject to anti-dilution protection. Those are really important. Mandatory conversion, if you're lucky enough to get to an IPO and you want to convert everyone to common and push them into the public markets, and other IRA covenants as well. So once, yeah.
Hi. Thank you, Jason, and thank you, Eric. That was awesome. I have a sore throat today. Please bear with me. My question is this.
I think we might have.
Okay. I'll start from the beginning. Thank you, Jason, and definitely thank you, Eric. That was it was a lot to take in 45 minutes, but it was very illuminating anyway.
Thank you.
I work in the behavior space. We work with behavior technology. That is, a lot of the medical behavior science professionals are aware of what we are doing, but it's still a little bit of a emerging area, if you will. So one of the things I have been asked this question just once, but this question kind of comes up when I'm talking either with the analysts within an angel firm or even with the actual angel investor themselves. The question is this. Or, I'm sorry, my question to you is this. When we are talking about the term sheet, or just before they're giving us a term sheet, in that conversation, there is always this some kind of underlying theme of Harsh. What if we don't? What if we want to get rid of you? Bluntly speaking, we might want to get rid of you within 6 months, 1 year, 2 years, because the underlying concept is, wow, Harsh, I think you have a great thing going here, but we would be looking at ways of getting rid of you and taking over the whole thing, kind of.
Yeah.
What in that initial conversation, or what in that initial term sheet, which is a 3-4 page document, should I be looking out for, or is that something that will only rear its head later on?
Yeah, I mean, it's to the extent you have other options of investors to go to. It's not the best sign, and it's not something that you should expect to hear. Unfortunately, if you talk to a lot of VC investors, one common theme that you'll hear come up a lot is they invest as much, if not more, in the founding team than they do in the product or idea.
I'm so sorry.
Yeah.
I sincerely apologize. Now that I think about it, these were representations. These were people who were mostly representing insurance companies. I apologize.
Insurance companies.
Yes. Yes.
Okay.
not necessarily VC groups and angel groups.
Yeah. So how would the insurance company want to remove you? Yeah.
Hey guys, appreciate it. Very, very informative. So I'm very glad I could make the call today. Just a quick question. So kind of in the fundraising process right now, and speaking to some of my founder friends who've already raised capital, and one of them in particular had done this thing where they had different, or like the same investor in at different caps. So like, let's say they had like X amount of money at a 5 mil cap, and then they got in the rest at an 8 mil cap, and then put in more money. Like, what's your thought on that? Is that like something that's typical that happens? Is that something that is like a pain to deal with later down the line? Just wanted to like try to wrap my head around that.
Yeah. Good to see you again, Lewis, by the way. It's both something that happens somewhat commonly and something that could potentially be a pain. So as like a baseline of Delaware law, every time you issue shares at a different share price, you have to issue those as a different series of shares. So a lot of times what happens when you have your first financing round and you have a bunch of safes and or convertible notes, they're all priced differently based on discounts or valuation caps. And each one of those different priced convertibles will convert into a different series of shares. And what you'll see is something like the Series Seed 1 will be the new shares that you're issuing to the new investors in that round, and then Seed 2, Seed 3, Seed 4, so on and so forth will be the different priced convertibles that you've issued. It does complicate the cap table later on. It's not the biggest deal, but it makes it, there's some administrative burden. You want to try to kind of limit the amount of different series of preferred that you have because things can get unwieldy later on. There's also a kind of a theory in Delaware law that if you have a down round or you need to kind of do what's called a cram down financing, where you have to cram negative terms down onto investors that are already in the company, that each one of those series of preferred could potentially have a vote, and in so having a vote, have a veto over your ability to do those things. And what ends up happening is you have potentially like single investors that at a later stage in the company would actually never have voting influence over the company that could potentially have a lot of influence in these later rounds when you're trying to force them to stomach terms that no investor actually wants to stomach. And then you could find yourself in a serious governance issue. And so I tend to say, if you have two different prices of safe rounds, maybe three, that's fine. That's not the atypical. You see some companies that have like 5 or 6 or 7 or 8, and it starts to get crazy and it could have really bad kind of unintended consequences down the road. But I also think that to the extent that you're getting investors are coming to you and you're trying to raise money in the first safe round, and they're saying, we're not going to give you higher than a 5 million cap, or 6 or 7 million. 7 million is probably more standard in a lot of ways. And you want to be closer to a 9 or a 10 million cap. You don't want to sell $1 million at a 7 million cap. You want to wait. So maybe you raise 500,000 at a 7. You invest that into the company and you roll the dice and you say, I'm not going to take all the money right now and take all that dilution. I'm going to raise in tranches. I'm going to see where this 500,000 gets me. Maybe 3 months from now, my product's more built out. The money's been put into the company. Theoretically, the value of the company should increase. And so you tranche out your kind of safe financing round. That is a perfectly fine strategy. It's just when you get to too many different prices that things get crazy and it looks bad to future investors and it makes the cap table really difficult to manage, and you have these potential future governance issues. Um, so it's not very common to have a fundraising consultant, and it depends on kind of how much they're looking to take of the round. I would say if it's a minimal amount and they're providing a lot of value, then it's certainly not a bad idea. I think in my experience, if you're going to someone who kind of sees themselves as a typical placement agent and they want to take a significant potentially portion of the money that's coming in or the equity of the company, more specifically the money that's coming in a lot of ways, investors really don't like that. And I think that there is an attitude in the VC community in general, which isn't necessarily wrong, of like wanting founders to go out and like cut their teeth trying to get out there and find VCs and raise money and do it themselves. And if they see this, it might look a little bit lazier. It might look like they're not quite determined enough to get out there and do it themselves. And, in an investor market right now, especially where there are a lot of deals out there and investors are kind of picking the ones that they want the most, it could make the difference between someone wanting to invest and someone not. That doesn't mean that using services that are kind of, where it's a reasonable balance and they're facilitating certain aspects of what the company might do in the fundraising process will never work and will always be the bad idea. But you want to be really careful about how much you are agreeing to give to fundraising consultants. Also, fundraising consultants need to be registered broker dealers. They need licensed broker dealers. It is, you never want to have someone that is just like a consultant, quote unquote, and they're going to get a success fee based on a successful fundraise. It's a regulatory violation. There could be penalties for the company. The investors could unwind. There's a bunch of bad things that could happen out of that. So just always be aware of that. Yeah.
Hey there. I'm curious, Eric, if you have any experience with equity raises of companies that came from venture studios and just your view of those relationships, those cap tables, etc.
Yeah, certainly do venture studios, as well as incubators, accelerators, kind of all across the board. A lot of these different early stage kind of growth mechanism entities. It depends. I know that's not a satisfying answer, but every venture studio is a little bit different in terms of how they work, what they do. If they come up with the idea internally and they hire someone in to run it, sometimes they take a little bit more equity. Um, Sometimes they meet someone, they kind of come up with an idea together. Maybe they should take a little bit less equity, but um, the issue with venture studios can be that um, there is a decent amount of equity that goes to a party that is not continuing to provide services potentially in the longer scheme of the company. And investors might worry about whether the founders, the actual management of the company ongoing is properly incentivized based on the amount of equity they hold versus the venture studio and the other employees of the company and what the investors are getting when they come in. It doesn't make companies uninvestable, but it's something that you want to consider. And again, I mean, it depends on kind of the terms that you get, and some terms can be really negative, like very favorable kind of off-market anti-dilution provisions on the behalf of the venture studio. If you could prove that they are continuing to provide value past a certain point of the company, maybe it's not that big of an issue. But it's the same issue if you have a departed founder. This is not the topic that we're having today, but you always want to subject founders to vesting, especially if there's multiple of them. Because if you have someone that leaves the company, a founder that leaves the company with 20 or 30 or 40% of the company, that can really have a harmful effect on the company's prospects of fundraising going forward. So I'm not saying that a venture studio has that harmful of an effect, but you want to think carefully about the amount of equity that a venture studio is getting and what they're giving in return for that, and whether it's something that you need them to do or not, because there's only a finite amount of the pie. You have 100% of your equity pie. Obviously, you create more over time, and people get diluted down. But equity can be really expensive, and it's something that investors take into consideration, certainly when they're looking at companies. Yeah, yeah. These are the other slides here, and there you go. Classic example. It's always the uncle. Yeah. It's always the uncle that doesn't do anything related to this type of work, but is jumping in anyway. Thank you very much for having me. Hope to come back soon. Later.